Welcome back to Iron Financial. If you blinked this week, you missed one of the most chaotic 7 days in market history. We are sitting here on Saturday, January 10, 2026, and the dust is finally settling on a week that redefined three major sectors of the U.S. economy. President Trump didn't just tweet this week, he fundamentally altered the playbook for defense contractors. He cracked open the energy sector with a geopolitical shocker in Venezuela, and he quietly launched a financial vehicle that might just be the biggest funnel for the stock market we've seen in decades. Normally, you get one of these stories in a month. We got all three in 48 hours. Investors are scrambling to reprice risk, and the volatility index is waking up for the first time in months. Today, we are breaking down the winners, the losers, and the flying under the radar story that nobody is talking about yet but needs to be in your portfolio. We're talking about the $1.5 trillion defense budget paradox and why dividend investors are panicking. We're talking about the capture of Nicolas Maduro and what it means for Chevron and the global oil supply chain. And we're talking about Trump accounts, the new policy that goes live in July that could flood the small cap market with billions of dollars of sticky, government-backed capital. If you are wondering why your portfolio looked so volatile this week, this video is the answer key. Buckle up. This is your market briefing. Let's get to work. Let's start with the headline that dominated the week, the defense sector. On Wednesday, January 7th, defense stocks like Lockheed Martin, Raytheon, and Northrop Grumman went on a rollercoaster ride that gave day traders whiplash. These are stocks that usually move like glaciers, slow and steady. But this week, they moved like crypto. Here is the setup. President Trump announced he is pushing for a massive increase in the military budget, aiming for $1.5 trillion by 2027. He cited growing tensions in the Pacific and the need to overhaul our satellite defense grid. On paper, this is the holy grail for defense contractors. More budget means more contracts, and more contracts usually mean higher stock prices. The stocks initially surged on the news, with Lockheed hitting a new 52-week high in pre-market trading. But then came the hammer drop. In a series of posts on Truth Social, and followed immediately by an executive order, Trump lambasted these same CEOs. He explicitly called out Raytheon, saying they are, quote, spending on shareholders rather than the needs of the military. He didn't just talk. He signed an order suspending stock buybacks and dividends for major defense contractors receiving federal grants until they prove they can speed up production lines by 20%. He is effectively demanding that every dollar of profit goes back into the factory floor, not into your brokerage account. This is the Trump paradox we have been warning about. You have a massive tailwind, trillions in government spending, colliding with a massive headwind, strict government control over capital allocation. For years, investors bought stocks like Lockheed for the safe, steady dividend. It was a bond proxy. A safe place to park cash. Now, that dividend is frozen. The income investors who rely on those quarterly checks panic sold immediately, driving the price down 8% in a single afternoon. So, what is the play here? The market reaction was panic selling from income investors who need that dividend. But look closer at the fundamentals. If these companies are forced to reinvest that cash into factories and R&D instead of buying back stock, we could be looking at a massive growth phase for the industrial sector. This forces innovation. It forces capacity expansion. We are seeing a smart money rotation out of the financial engineering defense plays and into the pure production plays. Watch companies like General Dynamics, who have been quieter on the buyback front but heavy on production. They held up much better this week. The takeaway? The defense sector just went from a safety trade to a growth trade overnight. You have to change how you value these companies. If you are holding them for income, you might be out of luck. But if you are holding for long-term capital appreciation, the government just guaranteed their revenue for the next decade. Adjust your portfolio accordingly. Now, let's pivot to energy. If the defense news was a policy shift, the energy news was a geopolitical earthquake. On Monday, January 5th, following the U.S. operation that resulted in the capture of Venezuelan President Nicolas Maduro, President Trump vowed to unlock Venezuela's oil reserves. He framed it as a move to stabilize global energy prices and reduce reliance on Middle Eastern supply chains. The market reaction was instantaneous. Chevron, which already has the special license to operate there and has boots on the ground, popped 5%. Halliburton, which provides the drilling services needed to fix Venezuela's broken infrastructure, jumped almost 10%. This is a massive reopening trade. We are talking about the largest proven oil reserves in the world suddenly coming back into the Western sphere of influence. But here is where you need to be careful. The bearish case for oil right now is a supply glut. We already have record US production. If you suddenly bring millions of Venezuelan barrels back online, basic economics tells you the price of crude should crash, right? That's why we saw crude futures dip below $65 initially. But the smart money is betting on the capex cycle, the spending, not the immediate supply. Venezuela's infrastructure is rusted out. It has been neglected for a decade. It will take years, maybe until 2030, to get Venezuela pumping at full capacity. In the meantime, billions of dollars need to be spent to fix the pipes, the rigs, and the refineries. That money is going to American service companies. That is why the services companies Halliburton and Schlumberger are outperforming the producers like Exxon this week. The money is in the cleanup, not the pumping. If you are holding energy ETFs, check your exposure. You want to be heavy on the guys who fix the wells, not just the guys who sell the oil. The Trump administration has signaled it wants American companies to do the rebuilding. This is an America First infrastructure play, disguised as a foreign policy win. The contracts to rebuild Venezuela's grid are going to be written in Houston, Texas. That is the trade. Now, I want to talk about the story that is flying under the radar. While everyone was screaming about buybacks in Venezuela, the Treasury Department quietly released the details for the new Trump accounts, launching this July. This was a campaign promise that many thought would get watered down in Congress, but it passed, and the implementation details were just uploaded to the Treasury website. Here is the deal. Starting July 5, 2026, the government is seeding a $1,000 investment account for every eligible child born in the U.S., with a $5,000 annual contribution cap for families. It operates like a Roth IRA, tax-free growth forever. Why does this matter for your portfolio today? Because of the investment rules attached to these accounts. The specific language in the rollout indicates these funds must be invested in American enterprise funds. Analysts are interpreting this as a mandate for broad U.S. equity indexes, excluding foreign tech. This massive inflow of passive capital is going to disproportionately benefit small and mid-cap stocks. Think about it. The mega caps, your Apples and Nvidias, are already saturated with ownership. Everyone owns them. But the Russell 2000 has been lagging for years. When billions of dollars of new, sticky, government-mandated monthly flows start hitting the Russell 2000 index funds, the buying pressure on those smaller companies will be explosive. Small caps are illiquid compared to large caps. It takes less money to move the needle. We have already seen the Russell 2000 start to curl up this week in anticipation. The smart money is front-running the July 5th start date. The pick and shovel play here is also the custodians. Fidelity and major banks are gearing up to manage these accounts. But the real alpha is in the small cap index itself. The market is a forward-looking machine. It is starting to price in this wall of money that hits in July. If you have been ignoring small caps because of high interest rates, this policy might be the catalyst that finally reverses the trend. We are looking at a government-sponsored floor being put under the U.S. small cap market. So, how do we tie this all together? We are seeing a specific theme emerge from the White House this week. It is a philosophy of tangible assets over financial assets. Trump is punishing defense companies for financial engineering, buybacks, and rewarding them for building factories. He is rewarding energy companies that can physically rebuild infrastructure in South America. And he is creating a savings vehicle that forces capital into the broad American market, not just the top 7 tech stocks. If your portfolio is still positioned like it's 2024, heavy on tech, light on industrials and energy, you might want to rebalance. The policies we saw this week from the Trump administration are inflationary for stuff, steel, oil, machinery, and potentially deflationary for paper, pure financial assets. I am looking at increasing exposure to defense industrials, but avoiding the ones dependent on dividends. Look for the builders. Oil services, the fixers, not just the drillers. Small cap indices, to front run the July inflows. This is a rotation from growth at any cost to growth in the real economy. Next week is going to be critical. We are waiting on the Supreme Court ruling regarding the new tariff waves. Rumor has it a decision could drop by Tuesday. If the court upholds the president's authority on these new reciprocal tariffs, expect another repricing in the retail sector. We will be covering that breaking news right here as soon as it happens. We are watching the wires so you don't have to. If this breakdown helped you make sense of the chaos, do me a favor. Hit that like button, it helps the algorithm get this info to more investors. And subscribe if you want to stay ahead of the policy shifts that are moving your money. Let me know in the comments, are you buying the dip on defense, or are you staying away until the buyback ban is lifted? And what is your take on the Venezuela situation? I want to hear your take. Thanks for watching. Stay sharp, watch your risk, and I'll see you in the next one. The information provided in this video is for general, informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.